This is highly recommended, and I want to talk to you today about why good credit is the key to a better life and how to get it. Imagine standing in front of two doors. Behind the first door is a life filled with opportunities. Your dream car with an affordable payment, a comfortable home in a safe neighborhood, and the ability to start a business without draining your savings account. Now, behind the second door, things are uncertain. You have limited options, higher costs for just about everything, and a constant struggle to catch up. For many, the door that they walk through depends on one critical factor: credit. Have you ever felt stuck, unable to reach the next level in life because of financial barriers? If so, you're not alone. Today, we're going to talk about one of the most powerful tools for transforming your life: credit. But what is credit really? Think of credit as your financial reputation. It's the trust that lenders, landlords, and even employers place in your ability to manage money responsibly, and it's the idea that better credit means better judgment. Now, while this is not always a perfect correlation and can be considered an unfair generalization, many of your credit decisions makers believe this nonetheless. As an underwriter, I know I am influenced a lot when I look at someone's credit, and I make assumptions about how they live their life based on the type of credit they got, the creditors that they use, and their credit history. But think of it also as your financial report card. A strong credit profile opens doors, while a weak one will shut them. Now, I want to talk a little bit quickly. I'm not going to go through the whole story, but this is a story I'll tell in another video about a client of mine that I called Leo. I named him after my big brother, but that's not his real name. Leo work is a part-time well, let me rephrase that. He's in the Air Force Reserves. He is a captain. Now, because of his officer status, he has a particular security clearance with the Air Force. Due to some erroneous issues that he had on his credit, his security clearance became under jeopardy, and he came to me for some help. I did some research, and we determined that the accounts that they were concerned about, most of them, all but one, were in error. That one account had been resolved years ago. And so through me helping him research that, clean that up, he was able to keep his security clearance intact. And I believed it allowed him to retain his rank in the military due to that clearance. So credit is more than just your ability to go out and charge up and buy stuff. It can affect your employment. Now, why does credit matter? And why does it really matter? Keep in mind that credit impacts nearly every aspect of our lives today. It affects how you live. Do you want to enjoy a memorable life with memorable family experiences through things like nice vacations? Credit affects where you live. Do you want to rent an apartment or buy a home? Landlords and mortgage lenders check your credit. What you drive? You need a car? A better credit score means a lower interest rate, which means a lower payment typically, or it means you can have the same payment and drive a nicer car. Of course, we know at many car dealerships, they won't even show you certain cars if your credit is not as such, unless you're paying cash, of course. Where you work, like Leo, the client, many employers review your credit to assess your reliability and your judgment. In his case, his rank. I'm assuming as a captain, that's a leadership position, and so that was an issue. Credit also affects what you do. Good credit can help you secure funding to bring your entrepreneurial dreams to life, whether it's a hot dog cart or a full on white cloth restaurant. And lastly, good credit can be a part of your emergency preparedness. Now, it's good to have strong credit, which will give you access to low interest loans and high limits so that you can deal with unexpected expenses when they arrive. Now, don't get me wrong, credit should not be a substitution for a good financial plan and a good ample amount of savings. But it is good to use as a fallback on that. To demonstrate a little bit of this, I want to talk about another client of mine's. And when she came to me to fix her credit, her dream was to buy a house. Now, at the time, she was living in a not so great part of town, sort of what we call the hood, and she wanted to move to the suburbs to the good. And so, through 14 months of work, we were able to get her there. But her credit was really bad. She was in the 400s, and it started out. She started working with me in August of 2021. And through the end of 2021 into December, through work, resolving some issues, cleaning up some things, I was able to get her to up about 80 points. So that was through the removal of collections accounts, and it was through managing her existing accounts and getting her scores up and eliminating late payments and things of that nature. Now, by January, February of 2022, she started having issues with the 2008 GMC SUV that she paid $9,000 for, had to put $2,000 down from her income tax refund just so they could give her a 16.99% interest rate loan. That vehicle broke down on her several times between January and March, on her way to work. And then so she lost confidence in the vehicle. Subsequently, in the month of April, she ended up buying a new car. She did one of the things I suggested often is establish that relationship with your bank or credit union so that you can get pre-approved before you go to the dealership, which can often work in your favor from a negotiation standpoint. She followed that instruction. She got financed with her credit union. She went to the dealership and she was able to get her a 2018. Now, this is 2022. She was able to get her a 2018 Honda Accord that she didn't have to put any money down on. And her interest rate was 3.99%. This is before the rates went wonky. And she had a nice, reliable transportation. So then she's proceeded throughout the summer to continue to build her credit. And by September of 2022, her credit scores were 680 and the other two were just above 700. So she felt she was in a good position then to start her house hunt. So I recommended her to one of my mortgage partners, and he pre-approved her. And she set about searching for a home. She ended up buying a home for her and her family. She signed contract in the middle of November. The deal closed the second week of December, and so she moved into her house just before Christmas. And all of that was due to the time, patience, and work that it took to get her from 450 to nearly 750. So how do you go about building and maintaining good credit? Building good credit isn't complicated, but it does require strategy, discipline, and time. I know there's a lot of folks on the internet that post things and they put tags and links in there that saying things like get your credit up in 7 days, or they'll say 7 days to fix your credit. this, that, and the other. They are implying that you can fix your credit in 7 days. But if you listen to many of the articles and stories and videos, which is what they want you to do, they're telling you what the things that you can do in the next 7 days that are going to work to fix your credit over the next 30, 60, 90 days. God's honest truth, y'all. There is no way to fix your credit in 7 days. There is no way to fix your credit in 24 hours, 72 hours, 2 days, 7 days. It takes at least 30 days to get things rolling. It can take longer, but that mostly depends on what you have on your credit and what do you want to do about resolving it. Because there are slow approaches and there are fast approaches, but they all have considerations. But there is no way, not any of the builder credit cards or programs, they set you up with loans with instant credit lines and things of that nature. They are all tools to help, but those tools have to be used the proper way. They cannot be used as shortcuts and hacks. They won't work. They don't work. I've had this conversation with many lender who wants me to try to fix someone's credit through similar to what we call rapid rescore in the credit industry to fix their credit. But credit restoration simply does not work that quickly. Believe me, if it did, I would figure out how, I would find out how, and I would sell that, because I would sell that all day long if I can fix somebody's credit. But I always fix somebody's credit that quickly, that is. But I can never understand. I've seen many people who have spent years, messing up their credit, for lack of a better phrase. Then I've seen them spend, after they couldn't do any more damage, I've seen them live with bad credit for additional years. And then when they finally decide it's time for me to clean this up, they want it done in weeks and months and days. That just doesn't make sense. No mess takes long. It's faster to clean up than to make it. So, like I always tell people, I say, if you think of credit as like if you took out the top drawer from your chest of drawers and you dumped it on the floor. Now, how long does it take for you? A few seconds to dump the contents of a drawer onto the floor. Now, how long does it take for you to straighten that drawer back up the way it was, where you fold everything up and put it back in the drawer? I guarantee you it's going to take a lot longer than the 5 or 6 seconds it took to dump it. Credit is no different. It takes time to clean it up, and it may not take as much time to clean it up. It probably takes as much time to clean it up as to mess it up, but it's how you want to live with it in between. But it takes time. It takes strategy. It takes discipline. So how do you start cleaning up your credit? Everything I'm going to tell you, you've probably seen before. There's no magic to it. It's pretty straightforward. The first thing you do, you have to pay your bills on time, especially when you consider that payment history is about 35 to 40% of your credit score. And that mostly depends on whether it's FICO 8 or Vantage 3.0. There's a slight difference in the pay history, but it is the single biggest component of your credit score. So it's very important that you pay on time. Now, if you're having trouble keeping track of when your payments are due, set up reminders, set up auto pay payments with them so that the bills get paid on time and in full. And if there's a budget issue or a timing issue, like say your car payment is due near the beginning of the month around the same time that your rent or mortgage is due, you can contact the creditors. Just about any creditor out there, if you contact them before you get behind or anything like that, you contact them and you say, hey, I'd like to move my due date on, say, my car payment. I'd like to move my due date from near the beginning of the month to somewhere in the middle or near the end of the month. And you just explain to them, you say, because I have rent or mortgage due early on and I have these two large payments, two of my largest monthly payments together, I'd like to have them on separate checks. They're more than happy to do it because they would rather move your due date and you continue to pay on time and they don't have to worry about it. But it's really easy. Usually you just have to call them and say, hey, I'd like to make arrangements to move my date They're pretty straightforward. All they have to do is go in the system, and then they send you out something as well, letting you know that your due date has been modified, and then just pay it as accordingly. That's an easy way to take care of that. You also want to keep your revolving balances low. Revolving being your credit cards or any other lines of credit that you have that you where you can charge on it, pay it off, and you charge it back up and pay it off. Those we call those revolving accounts. Now, the goal here is to not cross the maximum credit utilization ratio of 30%. Now, that 30%, that means that's 30% of your total credit limit. So if you have a credit card with $1,000 credit limit, you don't want to have more than a $300 balance at the end of the payment cycle when they report the balance for the credit reporting. So if you use the card, you want to pay it down before, not on the due date, but before the payment period ends. And if that's difficult to keep up with, then I just tell folks, just don't go over the 30% when you're charging things on your card, your account, and don't hold the 30% too long, because for every month, for the longer you carry your balances above 30%, the more they start to ding your credit score 5 and 10 points per month as that balance remains over the 30% ratio. So consequently, as you bring it back down, the longer you keep your credit ratios below 30% over time, you accumulate more points to the positive. Now, I often tell my clients, yeah, 30% is the max, but I say shoot for 20 to 25%. And of course, it gets easier as you raise your credit limits. And I'll show you how to do that, because it's really, really difficult to maintain a 30% credit utilization when you have a $300 secured card and you can only use $100. And most people don't do that. It's real difficult. So that's why it's important as you build your credit. The key is not to build more debt. You build your credit by building capacity, by having higher credit limits. Don't mean you have to use them. You have higher credit limits. I mean, I have credit cards with credit limits $10,000 and higher, but of course my balances are nowhere near that. But I've accumulated those over time because I've maintained low credit utilization ratios that the lenders like to see. Another part of my success is I monitor my credit. Now, I use Smart Credit. I'm also in partnership with Smart Credit. I think Smart Credit is a great credit monitoring service. They also have a built-in $1 million identity fraud policy when you maintain that as a member. So, I mean, for $25 a month to have just having the $1 million identity theft policy is great in and of itself. And I'll have the link for Smart Credit in the comments and the show notes down here. So if you're interested in that. But the important thing, whether you use Smart Credit or anyone else, the important thing is that you are using a credit monitoring service that allows you to see TransUnion, Equifax, and Experian. It's important that you look at all three bureaus, because you don't know if you're only monitoring one credit and there's an issue on another credit file. And if you got a lender that's looking at a singular file, unlike mortgages, they look at all three anyway. But it's important for you to monitor all three, because you need to know what's going on all three. Just because something's on one don't mean it's on the other two, whether it's good or bad. If it's good news, we want to make sure it's on all three, so all three scores are better. If it's bad news, we want to make sure we clean it up on all three, two or three, whatever it shows up. But the main goal in credit monitoring is to have an early warning to fraud, to major fraud, and to errors and discrepancies. I mean, sometimes things get reported wrong. Sometimes you're not aware. And by having that credit monitoring, you can see what's going on in relatively real time. And if you use all the proper alerts that are usually featured with these credit monitoring programs. You'll get notifications, but the important thing is monitor the report. Don't just look at the score and see if it goes up. Woohoo, it's great. If it goes down, what the hell? The important, look at the information, the file, see that it's accurate, see that it's complete, see that is, that things are there that are supposed to be there, things that are not supposed to be there aren't there. And so the sooner you find out about them, the sooner you can fix them. Building credit history. So, of course, we have to clean up credit, but you also want to be able to build your credit. Again, like I was talking about earlier, building capacity. That means having creditors increase your credit limits. And a big part of that, is goes with how you manage that credit utilization. But if you're new to credit and you're trying to get established, there's a couple things you can do. You may have to start with a starter card where that might require a security deposit. But most of the reputable ones, if you don't have any bad credit, they usually don't need a security deposit. They'll just start you out with a low limit, like $300, $400, $500. And then, of course, there are things you can do, like you can become an authorized user on a relative's account. Now, there was a time 10, 15 years back where there was a whole industry around selling trade lines. That means you pay someone some money, they got good credit, and they'll put you on their account as an authorized user, and then you get to piggyback off of their excellent credit. Well, the credit bureaus know that scheme, they're aware of that industry. So now being an authorized user on someone's account will only give credit to your account is if they are a relative, immediate relative, or even an in-law. And if they can do a check and make that connection between you and that primary user, they will allow it. Otherwise, they'll just largely ignore that information. It may show up on your credit, it'll read there, but it won't impact your score because they'll ignore it if they don't see a sort of a 6 degrees of separation of connection to the primary user. Okay, and then lastly, of course, you want to limit your credit inquiries. This is especially important when you're trying to build credit because, of course, to build credit, you have to apply for things. But to apply for different credit accounts to try to get the proper credit mix meaning the mix of different types of account. In a perfect world, and from a credit standpoint, they'd like to see a mortgage, a long-term installment loan, an automobile loan, considered a short-term automobile loan, or possibly a signature loan of $4,000 or $5,000. That's usually a short-term loan, 5 years or less. And then coupled with that with maybe 1 to 3 credit cards, all with low credit utilization, 30% or less, and with fair degree of credit limits. And that makes a good mix of credit accounts on you, and that you're managing all of those different types in a meaningful way. I can tell you that that's true because that's what mine's looks like. And I'll tell you, I'm 800 score. I've been 800. I've been 800 scores for almost 20 years, and I have multiple credit card accounts. I don't, and I have high limits on all of them. And I don't have large balances on them. I use my cards sparingly. I do use them for big ticket purchases, which I usually try to pay down in increments if it's, multiple amount. But I can tell you though, everything that I talk about works. It works because I've done it, I do it, I have it. I can show folks, anybody that doesn't believe that I, know what I'm doing and that I'm able to do these things, not only for myself, for other people, I can easily prove that. But again, back to good credit and the better life. So, what are the long-term benefits of good credit? Well, I can tell you, when you take control of your credit, you can take control of your future. With good credit and good scores, you can save thousands of dollars of interest over your lifetime just on your borrowing. Just for an example, I can tell you, this. Suppose you're in the market, you're trying to get a mortgage, and say you're looking to borrow $160,000 for the purchase of your home. Now, assuming you had a credit score of say 580 to 620, which would be the bare minimum that you would need to qualify for a mortgage, you would probably have an interest rate on the high end. Now, I'm not sure as of this video where rates are exactly today, but I can tell you, generally speaking, in recent times, you would, with someone with marginal credit between 580 and 620 would probably have an interest rate, just say somewhere around 8.5%. So on a 30-year mortgage, $160,000 loan, that would be a payment of $1,153 a month. Now that's just the mortgage part. That doesn't taxes, insurance, but I just want to show you about the loan issue, the loan part of it. So again, 8.5%, $1,153 a month. Now, suppose you decide you want to build your credit up a little bit more. You're going to work to clean it up and make it the best credit you can get. So let's say you work, you do all the things I talked about, paying your bills on time, keeping your balances low, monitor your credit, build a good credit history and limit your inquiries, and say you improve your credit by 100 points. So now your credit score is in the range of 680 to 720. Right? What would a loan look like you would be able to qualify for? Well, you would probably be able to qualify for a mortgage loan, a rate of somewhere between 6 and 6.5. But let's just say, for the sake of argument, it's 6.5. That's 2 full percent points lower than your worst case scenario mortgage rate. Now, on that same $160,000 loan, that payment would be $948 a month. Yep, you heard me, $948. Now remember, on the 8.5%, it's $1,153, right? So that's a difference of $205 a month, give or take. Right? That's $205 a month for the same loan that presumably bought the same house. $200 difference just by having that much better credit and that much lower interest rate. Now, let's think about that for a minute. When people often say, man, it costs money to fix your credit. Like, say, if you got to pay off debts, pay off collections, things of that nature, pay someone like me who can assist you with your credit restoration. All of those costs, but they're all costs, whether they're money costs, time costs, effort costs, all of those costs. This is a lot of work. It's not even worth it. Well, let's look at the math and see whether it's worth it. That's $205 a month. That's $2,460 a year. Now, assuming you take this loan 30 years, that's $73,000, $73,800 to be exact, over a 30-year period. You still think it ain't worth it to fix your credit when you can get that loan instead of that loan? That's a lot of money. $200 a month. That's half of another car payment. $200 a month. That's money that can go into a mutual fund. And over 30 years, that $73,000 would have accumulated hugely in the stock market and investment growth. That's buying another property, an investment property to help build your assets and build your wealth. There's just a lot of things you can do with that $205 a month just by having better credit. Okay, besides that, let's talk about some of the other non-lending things. With that better credit, you're able to qualify for lower auto insurance rates, because a lot of people don't realize, I should say, that auto insurance companies look at your credit and the premiums that they charge you. Credit is a factor. I read a study recently, the data was as recent as 2022, where they determined that drivers with poor credit scores, now poor for the sake of this article study, poor was considered any credit score below 580. So 580. They said people with credit scores as low as 580 or lower than 580 pay 97% more on average for full coverage car insurance. That's 97% more than someone who has exceptional credit, say above 800. Now, granted, these are two extremes. Less than 580 is pretty close to the bottom. The mathematical bottom of credit scores is 350. Most people with a pulse in any kind of derogatory history is probably going to at least be in the 400s. The worst active credit score is probably 450. So you say 450, and then most people land, even when they do really well, because it takes a lot to get above 750 to 800. You got to do a lot of the right things right for a long time. But even though those are two extremes, when you say 97%, essentially you're saying is these people pay, less than 580 pay twice as much for insurance as people with higher credit scores. That's a lot to think about. I mean, double over the life of a car. And then every time you get a car and you have insurance, you're paying double just because your credit score is bad. That's a lot to think about. What about other things? Um, Qualifying for premium rewards on credit cards, miles and points and things of that stuff, and cash back. A lot of the credit cards that have those features in them, whereas miles, triple miles, sometimes they give you 50, 60,000 miles just when you sign up, and a lot of other perks, things like travel perks, like say, for instance, I'm an Amex member. And so when you go to most of the major airports, American Express has their own private lounge for American Express card holders. You got to be a card holder to go in there and enjoy the free coffee and snacks and other perks that and sparkling water and things like that they offer. Now, again, I'm not a rich guy, but I feel rich when I go to the travel lounge with my Amex card because I can walk in there and feel good about it, and it makes me feel like I'm a little richer. But that's again, that's that lifestyle thing. Having that car, having that credit, which gives me that card. I have two Amexes actually. Having those cards gives me those perks that makes me feel a little bit better and a little bit more special and rich. And I mean, that's something everybody can have, if you get to that point. So that's one of those intangibles. You can live large. But at the end of the day, aside from those lifestyle things, all the low rates that you enjoy on loans, auto insurance, credit card rates, things like that, cash back, which gives you money back, all of that stuff, basically, more importantly, saves you money that you can use. You spend less because you're paying lower rates and payments, which frees up money for you to put into savings so that you can develop a proper primary emergency fund. And then once that's funded, you have an emergency fund, like losing your job, 6 months rental expense fund, 6 months living expenses, things like that, a fund there. And then even better, money can go towards investing in, say, the stock market, because that's your first path to equity and ownership with an income producing asset. You can maybe go into real estate, and things like that, where you have rental properties so that those rental properties earn you money while you sleep. And that's a pathway to wealth. And I know for a lot of people, they think wealth means you got to be a millionaire or whatever. Wealth is wealth. Anytime you own something that pays you money when you're sleeping is wealth. It pays you money when you're not working. That's wealth. And that's what's more important. So, with you being able to live a better lifestyle through perks and rewards, you be able to enjoy lower payments and rates through better credit, and then being able to take that money that you save and invest to create wealth. You basically create a secure and financial independence. and you'll have stability both for you and your family. Because the important thing is to use credit to leverage your income. You don't want to build credit just for the sake of having the ability to buy more stuff, more junk. I mean, you do want to enjoy life. You do want to spend some. But the idea is you want to use credit to leverage your income. So, because what's faster to do? To save up, if you make $70,000 a year, what's quicker to do? Save up $200,000 to buy a house, or being able to finance a $200,000 house. You can get financing in a matter of weeks and days. It takes you years to save up $200,000. And not only that, you can use credit for other, you can buy other income producing assets. So anything you want to buy that can make money for you, rather than have to save up the money, why not finance it? And then take your money and have your money invested somewhere where it can grow. You can grow the money that you have instead of spending it, and make it have more money, get pregnant, have babies, as Myron Golden likes to say. And at the same time, you got financing in place. And if the property is making money, if that asset makes more money than it costs to have it, even if it's break even, it pays for itself. And then eventually it'll not only pay for itself, but it'll pay you. Either way, you grow in net worth by using your credit to leverage your cash. So you have credit challenges. How do you overcome them? I'm sure you guys want to know that. So if your credit isn't where you want it to be, don't worry about it. You can repair it, you can restore it, and you can rebuild it. But you may have to start small. When you have consistent steps, you can start small, have those consistent steps. And then if you want to feel like you want to go faster, you can always seek guidance from someone like me or someone like me who is expert in credit and can tell you the best actions to take. Because for my clients, I try to get them the most bang for the buck, and try within the reasonability of the system and how it works is to get things done as fast as possible. Okay. But I can tell you right now, if you're out and you're trying to figure out, you want to fix your credit, and I applaud you if you want to go through the effort of fixing your credit yourself. I mean, I'm here for the folks that want and need me. If you're a person who want to roll up their sleeves and say, I want to fix my own credit, that's great. But what I want to plead with you not to do is don't fall for any of the hacks, because there's lots of people out there that are charging money for hacks. They say, oh, you pay us, we'll get this. We'll pay this, you get this. Some of the programs that are designed to help you rebuild your credit, they're kind of hackish, because they're leading you to believe that if you sign up for their program and pay them their money, they may be offering you a financial product, a credit card, a secured loan, and things of that nature. But when they rely on giving you the impression that these things happen overnight and very quickly, avoid them, because a lot of times the money you spend on them, you could probably spend on, if you have legitimate debts that need to be paid, you could spend that money there paying down your debt and things of that nature. Because if you're paying for something that works, that's fine. But anybody that that tells you it's a hack, it's a shortcut, it'll fix your credit shortly, quickly, and quietly, I would say I would avoid them, or at minimum, really look into it. Don't just take what they say at value, because if anyone's promised you to fix your credit in 30 days or less, I highly doubt that it's legitimate in any real meaningful way. Now, there are some folks out there that do sort of things to try to mask, they're doing things to mask your derogatory items. Things like they may try to do secondary credit freezes, so that if someone does an inquiry or they do a dispute, and then now because it's a freeze, they can't the bureaus can't access your credit now because it's frozen. So then they take off anything that, it's not visible. In other words, they mask it, like I said, and make it appear as though your credit is better than what it is. If it does work long enough for you to do your transaction, I can pretty much tell you it's not lasting, it's not meaningful. You should seek to legitimately and permanently clean up your credit, not just some hack to try to get a loan in a short amount of time. And many of those make it worse. I mean, sometimes they make it worse because people try to dispute things and they reactivate old accounts and things like that. And sometimes they make it worse. So be careful when doing that. Work with somebody that's reputable, whether you're doing it yourself or whether you're doing done with you credit where you're working with a service. And beware of the ones that are just want to stretch you out with monthly payments. Um, and many of them, I'm not going to name any of them. If I said their names, you probably know them. Many of them just get you on the monthly plan. And I'm not talking about the DIY. I'm talking about the done for you, where they say they're fixing your credit. They get you on a monthly plan and they'll tell you it's a low plan payment, $59, $69. But what they do is they only attack one item at a time. And they go month on one item till it's done. Then they go month. So I know people who have been with them for 2-3 years trying to get their credit together. Now I have clients that I worked on to actually improve their credit for 18 months, 14 months, a year. But these were folks with really bad credit with a lot of issues that took a lot of work. And again, it's a year, but they had bad credit for 5-6 years. So it took a year to clean up 5-6-7 years of mess. But it takes as long as it takes, and it's permanent. People whose credit I fix, they don't come back to me saying the stuff that got removed came back. They come back because they got old new stuff. And it happens. People, it's a learning curve. But remember, bad credit is not a life sentence. It's a challenge. It's a challenge that you can overcome as long as you take the time and you have the proper actions. You can do it. Anybody can do it. I tell people all the time when people ask me to fix their credit and they ask me how much I charge, and I tell them, and they say, "Oh, wow, that's a lot. Can I do it myself?" I say, "Yeah, absolutely." And I tell them how. I tell them the steps. I want to see people win. Yes, this is my livelihood, but and I look to make a living with it. But if at the end of the day I can help you and I show you I can help you, at minimum, you'll at least tell somebody who may not want to try to fix their credit. This guy knows what he's talking about. He told me how to fix mine, so I know he can fix yours. And that says it all right there. Now, I'm going to tell you a story about a client of mine. I'm going to call him Marcus. All right. A few years ago, this was like right after COVID. Marcus, he was excited about buying his first car. He had always had hoopties. He had cars that he paid a couple $3,000 for here and there. He would drive them till the wheels fall off, so to speak. And he was really excited about, he said, I'm gonna get me a real ride. Now he wanted a Dodge Charger. And I was like, yeah, okay. But that's what he wanted. He had his heart set on the Dodge Charger. He even thought he was gonna get an RT. That's for those you don't know, that's the high performance one. So he went in the dealership. He had down payment money. He had like $4,000. So he's ready to put money down and everything. Now before he wasn't my client when he did this. He was my client after this. After this happened. So he said he went there. He had $4,000. He was ready to deal and whatever. And he saw one. He test drove it. Everything was beautiful. All right. Now, when it came time for them to run his credit, they told him, "Ooh, man, got some problems." He said, "Yeah, but I got 4,000 down." Because again, he's used to buying cars cash. So in his mind, a bunch of cash in your hand gets you whatever you want. That's true when you're buying used cars. But $4,000 in your hand only gets you so much with a brand new car because it's all down payment. And he said, he was kind of, his excitement quickly turned to disappointment. Um, Now, when he came to me, he said, "Man, I was trying to get this car. They told me I had stuff on my credit. So, like I do with all my prospective clients, I have them sign up for smart credit monitoring. And we run and we pull, we access all three bureaus. So I looked at this TransUnion, Experian, Equifax. And essentially what he had was he had a private student loan that he had. It was like a certification program, so it wasn't with the federal student loan program, anything like that. It was a student loan that he took out privately for certification. His employer would reimburse him. He had to pay for the loan, and then the employee, after he finished a certain amount of time working at the job, they will cut him a check when he passes this probationary period. And it was like, I think it was like 24 months or something. And then they would reimburse him for the cost of the certification program that he had. But in the meantime, he had a loan, it's on credit, and his payment history was real spotty with it. In addition to that, I think, if I remember correctly, he had a credit card that he hadn't quite maxed it out, but it stayed high for a long time. I know he was over 50% in his utilization, and he had forgot about it, and he had a spotty payment, and then they ended up rolling back, which happens sometimes. The creditor rolled back his line of credit to match what his balance was. So he suddenly became maxed out through no fault of his own. Well, it was kind of his fault because he didn't pay like he was supposed to. So all of that worked together to knock his credit score down. Now, in the defense of the dealership, they had a loan program to offer him. They were willing to do it. But the problem was it was sky high, and even with the $4,000 he had planned to put down, his payment was more than he anticipated. And he said, thinking about it, it was really more than what his budget allowed, because he didn't think it. He had anticipated a certain budget, thinking that based on what he put down on the car. So he decided, well, I'm not going to do that because I didn't really like that. So he walked away empty-handed, so to speak, no car. And so that's when he had came to me. And I looked it over, like I said, and determined, oh, this was the issue. So but he was determined to turn it around. He said, I want that car. I might not get it now, but I'm going to get it. So we came up with a plan on how to address those things. Now, again, those are only two things he really had. So we needed to, it's going to take time, because whenever you got late payments on installment loans, you got to get current, and then you got to have so many months, roughly 10 to 11 payments they'd like to see after that last transgression. And so he had time on that, and we got him under control. So he took some of that $4,000 and he got the credit card down. I showed him through use of credit utilization and over extended amount of time, and we got them to raise his credit limit back up. It was hard because of what happened before, but we explained it to him, and so they waited about 7 months, and 7 months, and he was able. They rolled him back. Well, actually, they rolled him up to 750 because he was originally I think 500. I think it was 500. They rolled him to 750. And then since then, his credit limit is almost at 2,500 now. But we got his credit utilization under control over time, which allowed him to build his credit limit history, build his credit, and all of those things. So after doing all of that and getting all that together and developing his credit, he ended up opening up another credit card in the meantime. So it was roughly about a year or so later, maybe 10 months, maybe 11 months. No, I'm sorry. It was like 13 months. It was a month over a year. He said, okay, I'm ready now. He had kind of bumped his savings because he had a good job. He made okay money. He's not married. He didn't have any kids. Well, he's not still not married, but he didn't have any kids then. He does have a little girl now, but he didn't, so his money was all his. So he was focused on doing this. He was living with his mother still, paying her rent, but he didn't have rent payments and all that stuff because he wanted to get this car first. So roughly about 13 months later, we got his credit score. We got him in the 640s, I believe. I think, yeah, one was 640, the other two were in the 630s. But more than good enough for him for the car dealership. And so he went, and he had $3,000, I think, something like that. About $3,000 he had to put down. He got a Dodge Charger, but he didn't get a RT because their prices have really gone up. But he got one with an S, it's a package or something. But he got his Dodge Charger, he got his dream car, and he had a good rate. He went to the credit union. He was able to get a good rate. And so he got a good rate. He got a payment that he was happy with. He got the car that he wanted. And essentially, the difference was the better credit score. The better credit score gave him better options. Even with the cash, it still didn't matter because he didn't have the credit. That's why I say credit leverages cash. So for you, remember this. Credit is not just about the numbers. It's not just about the score. Because even in a score situation, like me as a mortgage underwriter, we have underwriting guidelines when we determine whether someone is eligible to be approved for a mortgage to buy a house or a refinance of a home. And so numbers is a big part of it. There's a huge part of the underwriting process that starts with numbers, credit scores. But as underwriters, we look at the score and we look at more other things in addition to income and savings, assets, things like that to determine whether someone qualifies for a loan. So a human being is still looking at credit in a lot of arenas, and we're still making determinations. So it's more than just the numbers. We're looking at the other credit. We're looking at the collections, the type of credit and things like that to say, can we trust this person with this huge amount of money? And, and can we trust them to pay this back? Because assuming they go the whole distance, we got to ensure that they can make all 360 payments if they're doing a 30-year loan, of course. And so character is there. We look at that, but for you, it's about possibilities. So if you're someone who's trying to fix your credit or build your credit, it's about possibilities. You fix your credit, you clean up your credit, you buy, as a byproduct, you get a better score. It's about possibilities. What car do you want to drive? Anything's possible as long as you can afford the payment. What kind of house do you want to live in? Anything is possible with good credit, assuming you can qualify and pay that a bigger mortgage. If you're talking about a $3 million house or something. Where do you want to go on vacation? How do you want to travel? Do you want to drive across country in the station wagon? Well, I know they don't make station wagons no more, showing my age. Or do you want to fly? Do you want to have vacation at Motel 6, or do you want to have vacation at the Hilton, or something like that? Do you want to just go, not that there's anything wrong with either one of those, but it's possibilities. Good credit brings more possibilities, and so by learning what you need to do and having good credit, it's giving you tools. It's giving you financial. First, you get tools to help with your credit. Then once you got your credit good, your credit becomes a tool to help leverage your income, and your income and your credit become tools to live your life, to build wealth so that you can live a great life. And then, there's a lot of talk today. People talk about wanting to have generational wealth for their children, but it starts with you. So you got to have something to pass down. And credit can't be just, oh, I can go out and buy more crap. It's got to be about using credit responsibly to leverage your income to help build, acquire, or create assets that make you money, so that the more money you make, the more some money you save. The more money you save, the more money you have to invest, and the more money you invest, you have to make more money to come back to you. Again, your money getting pregnant and having babies. That's what credit does in the wealth equation. Credit is leverage, can be leverage. It can be used to leverage. It's not really leverage. You got different types of leverage, but credit can be used to leverage your income and help you acquire and create income producing assets. So, to build the life you deserve and to build your credit, you got credit, repair, and restore. Credit, monitor and maintain. Credit, build and leverage so that you can live well. So when you want to know why is credit so important, that's why it's important. Not just so you can go buy stuff, but so that you can go build stuff, build a life, build wealth, and build a future. So start today. Take one small step. Again, if nothing else, go to annualcreditreport.com. It's free. Get all three bureaus. Look at that first. If you want to start thinking about your credit and you don't want to spend one thin dime, go to annualcreditreport.com, request all three bureaus, TransUnion, Experian, Equifax. Look at that report, and it's your entire report. It goes way back. And look at that first. And then you start to decide, what do you need to do first to make your credit better, to make your life better. So ultimately, better credit can be the financial upgrade that you need. So now, imagine again, standing in front of those same two doors I talked about at the beginning. The first door, it's filled with all those great opportunities we talk about. That door is wide open, and you, with your good credit, are invited in. You have your dream car with your affordable payment plan. You have a comfortable home in a safe neighborhood. And maybe even that business that you funded with business credit and not necessarily your savings. Now, behind the second door, you got all that uncertainty. But you know what? Who cares? Because with your good credit, you're living behind door number one, and you don't have to give a damn about door number two. Think about that. I hope you find this video helpful. And if you have any comments, please share them in the comment, and that'll help me to make the next video. I hope you found this video helpful. I hope you found it inspiring. And if it's not, tell me that too. So I'll do something different, something that you may like. But I want you all to stay safe, God bless, and good credit.